US manufacturing and jobs figures overnight are solid. Japan's factory activity contracts, South Korea's growth rebounds, and central bankers hit the speaking circuit down under. That's coming up in our 5 Things in 5 Minutes on Friday, July the 25th. And then in our deep dive interview, ANZ FX analyst Felix looks at how sentiment around the world's major currencies have shifted through the year.
Sentiment has also turned around quite sharply on the Aussie, previously being quite negative around April, but now looking quite positive and in some sense getting up towards that positive herding territory as well.
But first, in 5 and 5 with ANZ, the US economy produced some solid growth data overnight. The S&P Global July Flash PMI showed the services sector expanded at a stronger pace this month, and weekly initial jobless claims suggested the labour market remains resilient, says ANZ economist Bansi Madhavani.
It's worth noting that companies are largely adopting a less hiring, less firing mantra, at least for now. What's that telling us is that the third quarter has started on a solid footing for the US economy, and that is broadly consistent with our view that the FOMC will keep the policy rate unchanged when it meets next week.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and Nasdaq were up 0.3% at new record highs. The US 10-year Treasury yield rose 2 basis points to 4.40%. Gold fell 0.8% to $3,371 an ounce, while West Texas Oil futures rose 0.6% to $65.66 a barrel. The US dollar index was up 0.2%. The Aussie and Kiwi are both flat, with the Aussie at 65.99 US cents and the Kiwi at 60.40 US cents. Number 2. A day after it secured a better than expected trade deal with the US, Japan's manufacturing PMI survey showed a contraction in July. Here's ANZ senior international economist Tom Kenny.
Uncertainty over future trade policy weighed on the manufacturing sector as it fell into contractionary territory from positive in June. Specifically, we saw the manufacturing PMI fall to 48.8 in July from 50.1 in June. The sub-indices of output declined at the fastest pace in 4 months, and new orders dropped to its lowest level in 3 months.
Number 3. One economy watching the Japan deal closely is South Korea. Its GDP rose 0.6% in the second quarter after contracting in the first one. ANZ economist Crystal Tan says semiconductor exports and fiscal stimulus helped. The big question now is whether Korea can achieve the same car tariff rate as Japan.
Japan and Korea do have fairly similar export structures, especially when it comes to the things that they export to the US. So the highlights from the Japan deal would be the reduction in the reciprocal tariff rate to 15%. And importantly, even for autos, which are under sectoral tariffs, Japanese managed to secure a reduction in that tariff rate to 15%. So if Korea is able to secure a similar deal, because Korean exports to the US, about more than a third of that basket is made up of auto products. If they can get a similar deal, that would actually see the effective tariff rate Korean exporters face when exporting to the US be reduced by almost 2 percentage points.
Number 4. Reserve Bank of Australia Governor Michelle Bullock said in a speech yesterday that trimmed mean inflation may fall a little further in the June quarter. ANZ Head of Australian Economics Adam Boyton found a few interesting comments in the speech.
The next sentence was interesting. We still think it will show inflation declining slowly towards 2.5%, but we are looking for data to support this expectation. So that does tend to put, I guess, a bit of weight on this CPI reading that we're going to get in Australia next week. Probably the other thing I'd take from the speech is that the bank don't seem to have been particularly spooked by that recent labour force print that showed the unemployment rate at 4.3. The governor essentially in the speech making the point that on average over the June quarter, the unemployment rate was in line with what the bank was forecasting back in the May statement of monetary policy, and that some of the forward-looking indicators of the labour market that the bank tend to watch aren't suggesting a sharp deterioration in the labour market.
Number 5. Reserve Bank of New Zealand Chief Economist Paul Conway also gave a speech on how tariffs and global uncertainty will likely dampen medium-term inflation pressures, all else being equal. Here's ANZ Senior Economist Miles Workman.
There is no such thing as an all-else equal world, and we have had other developments recently, in particular the government's investment boost policy, which is actually a positive story for business investment over the next few years. So, look, how those two things net out, that is still a big unknown, but I think the upshot here is the tariff story and the uncertainty associated with tariffs. We would agree with the Reserve Bank's assessment that that's a net negative demand shock for the medium term, and all else equal would require a little little bit more monetary stimulus than otherwise. But at the same time, there is still the government policies leaning against that as well.
Miles Workman there. Now, in our deep dive interview, ANZ FX analyst Felix looks at ANZ Research's updated FX sentiment and smart consensus research as we hit the halfway mark in 2025.
What we're trying to do there is look at what the overall, vibe is towards a particular currency. And so to do that, we're looking at what is the scope of our forecast revisions been on a certain currency in a given month. So looking at the G10 currencies and then seeing if there's any patterns there in terms of those forecast revisions. Now, in terms of maybe looking out for what we will call groupthink or what we term herding, that's essentially when we see several months, usually in a row, of forecast revisions going in one direction. We also include our smart consensus forecast. So what we mean by a smart, quote unquote, is essentially we're looking at the top performing forecasters over a year on a rolling basis and essentially seeing if there's a major difference in that group's forecasts with the rest of the forecaster community as well. So using both those tools, we can get a sense of what the sentiment is like on particular currencies. So what we've seen so far, we did an update recently, now that we're halfway through 2025, to see what shifts there have been in terms of sentiment around particular currencies.
So we're halfway through the year. What are you seeing in terms of sentiment around some of those major currencies?
Starting with the US dollar, of course, being the most important of the currencies we cover, really quite a big turnaround in sentiment over the last 6 months. So back in January and February, sentiment to the dollar was generally pretty positive, but now that's really turned around pretty starkly since then. Of course, we've had a lot of policy uncertainty in the US, tariffs being a big factor in that, and the growth risks that those pose to the US as well. We also have had concerns around the Fed and FOMC too, just given some headlines around the potential for the US administration to replace Fed Chair Powell before his term has expired. That's certainly been a big weight on the dollar as well. More recently too, we've seen maybe some examples there of slowing consumer income and activity too, which has been keeping expectations alive of further Fed rate cuts. So all of that's really been the biggest weight on the dollar. That's really been seen in some of the downward revisions to the DXY in terms of forecasts and the US dollar more broadly on G10 crosses as well. So overall in aggregate, the sentiment on the dollar is of course quite negative, but not what we would say at extremes just yet. But of course, if we look at different currencies, we will see different levels of sentiment there. So on one hand, when we look at some of the European currencies, so the euro and the sterling, sentiment there is certainly looking quite positive. So on the euro, of course, that's been because we've had announcements of German fiscal spending plans. Of course, the eurozone looking a bit more relatively stable in certain senses, given that there hasn't been that same degree of tariff volatility or policy volatility on that front either. So that's really been driving the big shift in sentiment towards the euro. Certainly the euro does look quite certainly in that sort of a positive herding territory when we look at the euro's measure in terms of our FX forecaster sentiment.
And how about sentiment around the Aussie and Kiwi dollars?
Certainly, the Aussie's been on quite a ride the last little while, having had a big fall in April in reaction to the April 2 tariff announcements and then rebounding after they were paused subsequently. But sentiment has also turned around quite sharply on the Aussie, previously being quite negative around April, but now looking quite positive and in some sense getting up towards that positive herding territory as well. Not quite as bright and optimistic as the euro is, but certainly getting towards that territory there. Our view is that while some of those immediate growth risks from tariffs are less acute in the near term, they're certainly still there in the background, and we will see the Aussie still be quite limited in terms of performance on the G10 crosses as well for the time being. Looking at the Kiwi as well, unlike the Aussie, sentiment towards the Kiwi is pretty neutral really in terms of our FX forecaster sentiment gauges. So maybe that does reflect some of the softness there ongoing in the New Zealand economy in terms of data, potential of course of the RBNZ to maintain that easing bias there too.
Felix there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, July the 25th. Catch you next week with a look ahead to the Fed's end of the month, will they or won't they, rates decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.